everyone, my name is Merpel Castro Hilaylay, your reporter for this day. So my topic is all about the credit risk versus interest rate risk and how is this two related. So the credit risk and the interest rate risk are the two types of risk that affect your bond investments. Investment bonds are often put into classes as either low risk or high risk. When you choose to invest in bonds, you're up against two kinds of risk: interest rate risk and credit risk. These two factors can have very distinct impacts on each of the assets classes within the bond market. So the key takeaways for this topic is that investing in bonds comes with two types of risk, which is the credit risk and interest rate risk. And also, bonds with a heavy interest rate risk are subject to changes in interest rates, and they tend to do poorly when rates begin to rise. And credit risk refers to the chance that investors won't be repaid for the amount they paid in, or at least for a portion of interest and principal. And also, both risk must be addressed in order to properly diversify your portfolio for the best results. Well, what is interest rate? So, interest rate risk refers to the sensitivity of a bond's price to changes in current interest rates. Bonds with more interest rate risk, that is a higher duration, tend to rise in price as the rates fall, but they tend to perform poorly or below par as the rates begin to rise. So we always keep in mind that bond prices and yields move into opposite direction. One result is that when the economy slows down, the slower growth leads to falling interest rates. In times like that, securities that are rate sensitive tend to do their best. What is credit risk? Well, credit risk, on the other hand, stands for a bond's risk of default. It is the chance that a portion of the principal and interest will not be paid back to investors. Individual bonds with high credit risk do well when their issuer is financially strong. But if the issuer begins to suffer, bonds with high credit risk will weaken. Entire asset classes can also have high credit risk. These do better when the economy is getting stronger, and they perform poorly when it slows down. And how is this two related? If there is a higher level of perceived credit risk, investors and lenders usually demand a higher rate of interest for their capital. Creditors may also choose to forgo the investments for loan. For example, because a mortgage applicant with a superior credit rating and steady income is likely to be perceived as a low credit risk, they will receive a low interest rate on their mortgage. In contrast, if an applicant has a poor credit history, they may have to work with a subprime lender, a mortgage lender that offers loans with relatively high interest rates to high-risk borrowers, just to obtain financing. The best way for a high-risk borrower to acquire lower interest rates is to improve their credit score. The best way for a high-risk borrower to acquire lower interest rates is to improve their credit score. Those struggling to do so might want to consider working with one of the best credit repair companies. Similarly, bond issuers with less than perfect ratings offer higher interest rates than bond issuers with perfect credit ratings. The issuers with lower credit ratings use higher returns to entice investors to assume the risk associated with their offerings. Well, there are factors affecting your bond investment. Both interest rate risk, the risk that interest rates rise, and credit risk, the risk that the bond may default can affect bond yields, as shown in the picture. This is an example. The band yields strengthen when interest rates rise and the high risk bands become less risky. And on the other side, bond yields weaken when interest rates fall and the high risk bands become more risky. Well, that's all for today. Thank you for listening. Thank you.